Good morning, everyone. Respected Shri Deepak Kumar Lalla, Chief Executive of Indian Institute of Banking and Finance, the keynote speaker for today, Dr. Soumyakanti Ghosh, Group Chief Economic Advisor of State Bank of India, Dr. Professor K. Gangadharan, Director Academics of Indian Institute of Banking and Finance, Shri L.V.R. Prasad, Director Training of Indian Institute of Banking and Finance, and all the esteemed participants for today's webinar. I am Dr. Kritika Srivastav from Academics Department of IIBF. Today, on behalf of the Institute, I welcome you all for webinar on budget and banks road ahead for VIKSHIT Bharat. As part of its member education series, the Institute has been organizing webinars on contemporary issues and developments in banking and finance domain. The Union Budget of India is a key instrument of public policy outlining government's fiscal priorities and strategic direction for economic development. It plays a critical role in resource allocation, influencing growth and equity, and ensuring macroeconomic stability across sectors. I now request Shri Deepak Kumar Lalla, Chief Executive of IIBF, to deliver the inaugural address and commence today's event.
Good morning and very warm welcome to all the participants and particularly to the Group Chief Economic Advisor Shri Soumyakanti Ghosh from State Bank of India. I am thankful to him for sparing time for this webinar. Webinar on budget and banks road ahead for the VIKSHIT Bharat. As we know that the Union Budget plays a very important role in shaping the economy of the country, and particularly when we are aspiring for a VIKSHIT Bharat by 2047. So there are a lot of measures has been taken by the government as well as in the Union Budget, particularly on infrastructure, capex push, fiscal discipline, focus on manufacturing, MSME, as well as I saw a lot of efforts have been taken by the government to see that how the simplification of taxes can be done. So being a banker as a professional, it's our role to see that yes, we also become a part of it, and we also provide our work as an enabler for it. From the banking side, if I see the budget, particularly our role in growth of credit, our role in financial inclusion, our role in digitalization, as well as our role in risk management. So there are a lot of things which bankers can do. I think during this discussion, Mr. Ghosh will cover all those points. I thank all the participants for joining for this webinar, as well as I request my colleague to introduce the speaker, Mr. Soumyakanti Ghosh, and then start the webinar. Thank you very much.
Thank you.
Yeah, thank you, CEO sir, and very good morning to all the participants. Keynote speaker Dr. Soumyakanti Ghosh, my colleagues, and all the participants. India is a bank-led economy. If India has to become VIKSHIT Bharat, banks have to play a major role. Various steps are being taken from the time to time to strengthen the banking systems by the government, regulator, etc. In the recent budget, lot of provisions are made by them, Finance Minister. There could not have been a better person than Dr. Soumyakanti Ghosh to well on the subject of the webinar, budget and banks, road ahead for the VIKSHIT Bharat, and decode various provisions for the better understandings of the participants. Before we hear him, I would like to give a brief introduction of the speaker. Dr. Soumyakanti Ghosh is currently Group Chief Executive, Chief Economic Advisor of State Bank of India, Member 16th Finance Commission, and Member Prime Minister Economic Advisory Council. Previously, he has worked at the Tata AIA, American Express, ICRA, among others. Dr. Ghosh has been a co-author in the pioneering work to capture payroll data in India for the first time, both formal and informal, and providing inputs in designing the PM Kisan scheme for farmer and the ECLG scheme for MSME borrowers that have been very successful during the times of pandemic. Following his report, EPFO and ESIC has started to give out monthly payroll data. Dr. Ghosh serves as the chairman of the Indian Banking Association's economist group. He is also a member of the editorial advisory board of the Indian Institute of Banking and Finance. Dr. Ghosh is also a member of governing board at the Indian Institute of Corporate Affairs. Dr. Ghosh is also a committee member that has been set up by the Government of India to revise the IIP, revise the WIP, and the economic classification of activities. Dr. Ghosh is also a distinguished fellow at InfraVision Foundation. For 8 successive years ending 2025, Dr. Ghosh has been ranked as one of the best individuals in research in India by the Asset magazine. He has an extensive list of publications in domestic and international journals and is a regular contributor to the OPEDs in print media and a commentator in electronic media on economic issues. Dr. Ghosh has completed his undergraduate degree from Kolkata University, post-graduation from Delhi School of Economics, and the doctoral thesis from JEM. This is only a brief introduction. With this brief introduction, I request Dr. Soumya Kanti Ghosh to please dwell on the subject of the today's day. Thank you so much, sir.
Yeah, thank you everyone, and thank you for giving me this opportunity. What I will do in the course of the next 30 minutes or so is that I will take you through some of the points in the union budget. I'll also touch about the current economic growth, and then we can have a short discussion if there are any questions. So let me start with the union budget. I think let me start with the economic backdrop. If you look into the economic, just a second. If I look into the economic backdrop, basically global growth has been moderating due to geopolitics and uncertainty, and central banks globally is now showing a preference for a pause. As you know that the Reserve Bank of India just announced the policy where they have also gone for a pause, and given the way things have been moving out, I think the pause may be prolonged unless there is some dramatic something happens in the Indian economy or the global economy, which looks highly unlikely. Most probably inflation will continue to decline, but it will stay above target in the United States, and emerging economies expected to moderate. You can see that graph over there, which shows that central banks have been cutting rates throughout in 25, 24, after they were hiking in 23. So basically the consensus is that these rates will stay at this level for a longer period. Next, if I get into the next slide, I think this was also a point which was mentioned by the governor during, is that the global yields actually has been diverging trend across regions. In India, the yields have moved up significantly, but in other countries like USA and UK, they have moved down. In other countries like China, Germany, and USA, they are actually moving up. So global yields, so basically Indian yields are also tracking the global yields. In some of the emerging economies like China, Germany, and Japan. And obviously the movement in yields are a function of several factors, which basically is going to impact the yield movements. And I think I will come into that in the course of my discussion on the budget. Next slide, if we say, I think the best thing to have happened is that after a long month of negotiation, India announced as a trade deal, I think the day before yesterday. India's tariff rate is now 18%, which is significantly lower across all countries. I think it is the lowest apart from South Korea, but you know that South Korean parliament has not passed this 15% tariff. So I think a couple of days back, the US president said that he is going to impose an additional tariff of around 10%. So if I take that factor into consideration, the tariff post regulation across South Asian economies is for India is the lowest. And India's share of exports, you can see the recipient to the country in total exports is around 2.1, and share of imports in total US is actually around 3. So US trade balance basically is around 53, which is on the lower side. So I think what we have done is that I think we have got into a deal, and I think in the last several months, India has got into several FTA deals. One of them is with the US. The other of them is basically with the UK. Then there has been also with the European Union. There has been with the Oman, in the UAE. So I think there has been New Zealand. So I think there has been India has signed around 8 trade deals in the last 1 year or so. And this basically is going to help the Indian economy in the current uncertain global environment. This graph is actually very interesting. This graph actually shows that after if you look into the 2009 recession, and then in 2020, the pandemic and the recovery, you will see that for the high income countries, the recovery post global financial crisis in 2009 and the pandemic in 2020 for high income countries, which is given by the pink line, was actually significantly higher. But the interesting point to note is that for the upper middle income countries, it was a little lower. For the lower in middle income countries, it was just a tad higher. But for India, which is basically a part of the lower middle income countries, and India will get into an upper middle income country by 2030, you can see that the India's recovery post 2020 global financial crisis was much higher than what it was in 2009. So that basically indicates that India actually is similar to the high income countries in terms of a recovery post the pandemic. So I think that's actually sets the context. So that shows that in the last couple of years, India's growth has far outpaced that of the global economy, and these factors should be taken into consideration. Now, what are the other things in the market capitalization? I think markets have been very volatile. But even within very volatile, I think, as you know, that the banking sector, and I think somebody mentioned that the banking sector has a crucial cog of wheel for the VIKSHIT Bharat. And in fact, in the last 5 years, the banking sector market capitalization has gone up, financial services has gone up by 4 times, which has been the maximum. And NSE market capitalization was 56% in March 2020 when the pandemic started, and it has now moved to 130% in 2025. So an overall market rupees 145 trillion was added from March 20, which is 50% of India's, I think 40% of India's nominal GDP at some point of time. So this is, I think, so the markets actually have behaved better, even though recently the markets basically have turned a little volatile. Now, if I get into the other next important thing is the external sector, I think the external sector, Indian goods and services actually has been significantly higher. It has moved up by 1.8 times from FY14 till FY24. We forecast that the overall oil prices could actually move towards 50. We remain the largest recipient of inward remittances, and the current account percentage of GDP will continue to be lower for a country like India. So I think all these are positive things which you should keep in mind. The problem is basically with the rupee. The rupee actually has been significantly volatile. But the good thing is that after the trade deal, the rupee has appreciated. The Indian rupee depreciation is almost now on par with the dollar index depreciation. And what is happening is that there has been enhanced offshore trading in the NDF market, which is providing the volatility, accommodating the volatility and provide the direction in choppy times. But the good thing is that the rupee has appreciated towards 90, and our sense is that if capital flows actually starts to bounce back, there could be an appreciating bias for the rupee in the future. But I think on the rupee front, it will continue to be volatile, whichever direction it moves in the future, because the global condition continues to be very uncertain. Now, the important point to note is that I think what has been the most important thing is that the last calendar year 2025 saw 11.8 billion portfolio capital outflows, and that has been the lowest since 2000. I think if you look into this in calendar year, this is, I think, if I look into the historical numbers, this is the lowest which has happened since 2011. So I think that means it's a 15-year low in the capital outflow, capital inflow into India. What has been happening is that globally there has been three themes which has been dominating the capital flow. First is artificial intelligence. The second is the significant turnaround in the mining. And the third is basically the defense stocks. So in all three of them, I think there has been a lot of speculation. For example, Brazil has a 50% tariff, but Brazilian currency and South African currency has appreciated the most because of the fact, even though India has a 50% tariff, which is similar to Brazil, which was similar to Brazil. But the point to note over here is that the point which to note over here is that India actually the speculation in the metal price in the precious metal prices and the mining activities, the defense and the artificial intelligence, all these actually are quite volatile in nature, and capital has flowed in that direction. Hopefully in the current year, if capital becomes more sober, it will flow back into India, and that could actually have a positive impact on the rupee. But I don't want to venture out at this point of time and say anything about the rupee in a very strong manner, because globally things are very uncertain, financial market in a precipice, and you don't know what is going to happen tomorrow, given the way the US economy and the US economic decisions have been taken. I think if, for example, tomorrow there is the conflict which breaks down in the Middle East, then there could be a significant increase in the commodity prices. So I think anything could happen. Then there's also this Greenland, which basically could be the Waterloo. So, and we don't know what is going to happen over there, because suddenly one fine morning you could find something happening. So my sense is that if you take all these factors into consideration, uncertainty will be continue to be the mainstay, unfortunately, in the current scenario, and we have to look for the certainty in uncertainty. So that's why and in this context, the budget announcement which has been made are quite positive. Now, let me get into some sort of the union budget now, having set the context. The union budget basically three things: continuity and predictability, economic development, basically building resilience and growth, people centricity is building capacity and fulfilling aspiration of the 140 for people, inclusivity, inequality, and development for everyone. And these are some of the things. Focus on labor-intensive sectors, infrastructure scaled up with 20 new national highways and high-speed train. As you know, India has announced 7 high-speed rail corridors. Sunrise sectors, there has been a lot of mention: semiconductors, data centers, carbon capture, utilization storage, critical minerals. And interestingly, the State Bank of India recently launched an chakra whereby it is also going to focus on the semi-emerging sectors, which is going to dominate in the future. And of course, long-term financing, high-level committee on banking for VIKSHIT Bharat will be set up, and there will be reforming of the RAC and PFC. Now, if you ask me about the things, the key highlights of the union budget, 3 responsibilities: economic growth enhancement, aspirations of the people, and every family, community, region, and sector has access to all resource, amenities, and opportunities. The other important thing, basically, I was a member of the 16th Finance Commission. 16th Finance Commission recommendation have also been taken into account by the government. So the tax devolution stays at 41%. But I think one of the important recommendations of the 16th Finance Commission, taking into account India's rapid urbanization, is actually 2.2 times jump in the overall fund disbursement for the urban local bodies. Local body grants have increased by 2.2 times. And the important thing to note is that I think urbanization premium and urbanization grants has been introduced as basic conditions for the states in the coming years. Fiscal deficit for the center is actually spaced at 4.3%. The nominal GDP is at 3.93%. So basically, real GDP growth of 6.5 to 7%. But my sense is that once the GDP numbers is revised, which is going to come out soon, I think in the month of February, the nominal GDP numbers could actually go up a little. So that's why the nominal GDP growth rate the government has assumed in the budget 10% is an underestimate. And along with the tax numbers, the buoyancy also has been calculated at 0.8. Possibly this takes into account the lower GST compensation cess. But if you look into the historical tax buoyancy over the last 20 years, it has been around 1.1 to 1.2. So from that perspective, budget numbers are very, I think it's conservative and highly achievable. The government debt target is 50% plus minus 1 by 2030. And in 2027, the debt to GDP ratio is estimated to be 55.6. If I look into the other things, the ease of doing business, I think reduction in pre-deposit stay on demand, composite assessment penalty orders. So basically, these are all income tax rules, then faster cargo clearances, enhancing ITC refund facilitation for exporters, global investment and attracting incentivization of India-based data centers, relief announced for electronic goods toll manufacturing, and IFSC tax holiday extended 20 years. Interestingly, this IFSC tax holiday was a demand for the banking system, and specifically by the State Bank, because as you know that these the larger banks like State Bank has got into the IFSC much larger than the current players, and they were also instrumental in stabilizing the IFSC in the beginning. And now the IFSC actually has been doing quite well. Next is basically if we look into the recovery text mining, if we actually look into this, is basically you have done the machine generating analysis of 2014, 15, 21, 22, and 26, 27. What is the text which is basically restores over the budget, over the last 10 years budget? So there is a coherent progression in fiscal strategy. It was aspirational driven, intent and confidence restoration FY15. As you know, India was a part of Fragile 5. There was a resilience building and institutional consolidation in FY22, which you can see in that the words. Now the idea is on productivity-led, credibility-anchored growth framework for FY27. So it's from aspiration, we have moved into a situation whereby we have to this growth framework, which is more credible than it was earlier. Then basically, if you look into the fiscal deficit, the FY27, the budgeted, if you look into the fiscal deficit over here, FY26 but fiscal deficit around 15.6 trillion. This number has moved up to 17.7 trillion. So basically, what is pushing up is that the capex increase, I think so basically there is an increase of around 1.3 billion. So, and 1.3 billion is of course coming from the tax, from the capital increase. There is also a revenue expenditure increase, and gross tax gains is going to be around 3.3 trillion. So I think overall the fiscal deficit continues to be sound and credible. In terms of the capital expenditure most importantly has been pegged at 12.9 billion. But if you actually look into the grants for the creation of capital assets, capex by the CPSC, then the total capex requirements actually is 22 trillion, which was 18.4 billion in FY20 budget. So basically, if you just look into 12.2 trillion, that will not give you a complete picture, because you have to look into the grants made to the states along with the capex by the CPNC. Includes the total expenditure, although it doesn't come within the budget. But basically, the important thing is that the total capital expenditure is actually at rupees 22 trillion. If we take into account all these factors. So that's a very large number. Tax revenue and buoyancy, as I said to you, the center's gross tax revenue has been raised to around slightly downwards, around 40.8 trillion, which is basically a loss of around 2 trillion, 1.9 trillion, which was expected given that the government has actually consolidated the tax in terms of an income tax contracts, and also the Income Tax Act, and also the fact that the budgeted the GST collections. FY27, the government has budgeted 8% growth rate, corporate tax is 11%, income tax is 11.7%. The tax buoyancy is estimated by 8%, which is basically an underestimate. Our sense is that the government is trying to look through the system in terms of the GST collection. Possibly this actually will possibly this indicates that the tax collection actually will be much larger, than what it is anticipated. Next, if we look into the market borrowings, I think one of the important negative, I'll not call it a negative, but the overall gross market borrowings of FY27 is basically around 29.8 trillion, basically close to 30 trillion. Net borrowings is around 20 trillion. And our sense is that the government is likely to increase the buyback in the budget. I think the total repayments is around 5.5 trillion. So my sense is that 17.2 trillion, repayment is 5.5 trillion, and net borrowings is 11.7. So basically, if you more have buybacks, then these gross borrowing numbers will actually go down. And please note that these gross borrowings numbers, are actually what I will say. Could be lower later, because last year also, if I remember, this buyback was announced outside the budget. So I think the market actually should, I understand this, and my sense is that over a point of time, the yields also will be acting accordingly. Next is the financing of fiscal deficit. If you look at the financing of fiscal deficit, continues to market borrowings. The small saving collections actually has been kept at a little lower level, possibly to take into account maybe the muted collections in FY27. I think these numbers is likely to be achieved. So overall, I think the net borrowings as a percentage of fiscal deficit continues at around 70%. So, and I think that demand for securities from banks to be in line with the incremental supply, which is around 7.6 trillion. So I think is going to be manageable. Now, in terms of the non-tax revenue, if you ask me, I think non-tax revenue is budgeted at the 6.7 trillion, which is almost at the same level. RBI dividend is assumed as 3.2 trillion. And the important point to note is that the disinvestment target by the government actually has been raised to 33.837 from 47,000 crore previously. And this year's number is also on the higher side. The target for FY27 has been set at 80,000 crores. So I think this year could actually, you can see a lot of market movements in terms of the disinvestment priorities of the government. So this non-tax revenue, the numbers could actually go a little bit higher. So because 80,000 crore is not a small number, my sense is that the IIBF and other things will actually happen next year. This year may not be, there will be time. And maybe some other consolidation, some other disinvestment activities, which will give a boost to the market. Next, if you ask me, the investment ecosystem reported a significant development. If you look into the new investment announcement, it is around 52 trillion. The share of the private sector announcement has crossed 70%. And new announcements have been made in renewable energy, roadways, railways, residential building, basic metal, electronics, data center, chemicals, automobiles, etc. But the important point to note is that the announcements are at an all-time high. So possibly the focus should now be more on execution. Next, if we just look into the 16th Finance Commission, I'll spend a little time over here, which is betting on financial liquidity. I think this will look into the numbers of financial. This is tax devolution. Overall taxes, the 41% will go to the tax. And if you actually look at the total transfer to the states, sum of tax devolution, FC grants and non-FC grants, the states gets around 55% of the gross tax revenue of the center. So this shows that the states have actually enough money. The idea is to spend that money more wisely. So I think this is actually against a narrative which goes on that the states doesn't get enough money. But if you look at, and these are all in the budget document, the states actually get more than 50% of the gross tax revenue of the center. So this is basically, and if you look into the after devolution earlier, what used to happen, the devolution, before the devolution, the share of the states was 33 and the center was 67. After the devolution, the share of the states have gone up to 65 and the center has actually come down to 35. So basically, I think the states have enough money, but our sense is that I think the states need to meet the money wisely in the future. Now, if you look into the 16th FC criteria, the criteria matrix, you will see that for the first time, we have introduced a demographic performance, which is basically 1971 to 2011. And the important point to note is the per capita, the contribution to GDP. So we have now assuming that the contribution to GDP basically is one of the conditions for devolution. So that's why you will see that states like Karnataka, states like Kerala, states like Gujarat, states like Maharashtra, actually states like Haryana, and to some extent Tamil Nadu have actually gained in tax devolution in the current fiscal, which is basically a well development given the things that they have been doing. In terms of the interstate share of the states, I think this gives a figure. We can hear that. I think you can see that there has been a significant jump in southern states like Karnataka and Kerala if we compare with the last one, and also in states like Gujarat, Haryana, Assam, Andhra Pradesh, Punjab, and even to states like Telangana. So I think there has been, the Finance Commission has tried to balance equity and efficiency in an optimal manner. Now, if you look at the grants to local bodies, I think this is the most accelerating part. The total grants to local bodies, which was 3.6 trillion in FC15, has now moved to around 8 trillion in FY16, of which the urban grants actually has moved up by 3.5 trillion, which is basically an 121% increase in urban grants. I think in FY15, the numbers of the overall grants was not significant, but the 16th Finance Commission has significantly increased the grants to ensure that the local bodies are also a partner in India's growth story. And I think this part we need to emphasize. In India, the tax to GDP ratio is around 12% for the center, 7% for the states, but it is only 0.4% for the local bodies. And you know that India, to be a VIKSHIT Bharat in 2047, India has to develop its urban infrastructure. So therefore, the significant emphasis on the urban infrastructure, which has been given. And we are actually expecting that India's urbanization could actually touch 40.7% by 2031. So I think these are some of the developments which you should remember, which is not a part of the budget, because the budget also has given an urban infrastructure fund last week, but you may actually hear more on it in the next couple of years budget as we progress along. The disaster management grants also, I think, has significantly gone up. It has gone up to 2.05 trillion. The expenditure of the states, you can see that this is the expenditure on states. The drought, the cold wave, the cyclone, and all these things are significantly higher. And our sense is that there has also been a significant increase in disaster management fronts. Now, before I end, I will actually move to the sectors. Let me talk about some of the sectors which has been done in the budget. The first is basically there has been a high-level committee which has been set up for the banking sector to take forward the vision of VIKSHIT Bharat. Then there has been in IFSC, the period of deduction for units in IFSC has been extended, effective from 1st April. This will give a big boost to the banking and financial sector. Data centers, the budget actually has proposed tax holiday for data service centers till 2047. Then the big vision for NBCs for VIKSHIT Bharat. I think today the Reserve Bank of India also took several steps in terms of NBFCs, the one restructuring the PFC and the REC, and market making framework and total return swap of corporate bonds. So I think these are important developments. Next is basically the agriculture and allied sector. If you look into the agriculture and the allied, I think the most important thing is that Amrit Sarovars and 500 reservoirs will be set up. This is very important. Actually, when we were traveling across the 28 states in India, we found out that Amrit Sarovars has been a crucial part of all these states and panchayats in terms of the one. Then the animal husbandry, high value agriculture. So coconut, basically existing revised scheme, the coconut could actually come in under that. Then AI tool basically will be used to integrate the AgriStack portals and the ICR package and policies. Then self-help entrepreneur marts. I think the Lakshmipati Didi has been a large success. And I think on the same lines, the government is actually now trying to do a self-help entrepreneur, which is basically a more scaled up version of that, which will further increase the demand under existing Shamshid and Nari Shakti initiatives. I think this will empower the rural women significantly. For the MSME sector, the most important thing is that basically the liquidity support through trades. I think this was one of the long-standing demands for a bank like us. So any purchase from the MSME by the CAPC will be actively a transaction settlement platform with the trades. And this will actually unclog a lot of liquidity problems for the MSME sector. For professional support, the government has asked professional institutes to develop a cadre of corporate mitras, especially in Tier 2 and Tier 3 towns. So they will actually help the MSMEs to help file their returns. And I think this has been this is going to be unclog a lot of developments for the MSME sectors. Courier exports 10 lakh will go, and creation of champion MSME with dedicated capital outlay of 10,000 crores. So this is also another positive step for the government. For the manufacturing sector, I think a lot of things has been happened. India Semiconductor Mission, as of August 2025, 10 semiconductor manufacturing and packaging products have been approved, 1.6 trillion. There will be a dedicated art corridors like Odisha, Tamil Nadu, Andhra Pradesh, and Kerala. You know that rare earth is going to be one of the most crucial minerals in the near future because all the industrial developments, and I think it's a good thing that the center is actually trying to develop a corridor. Then there'll be chemical parks. That is a very welcome development because India's import a lot of chemical container manufacturing for significant cut in the logistic cost, integrated program of textiles, and then also electronic manufacturing. I think budget has proposed 40,000 crore boost of electronic manufacturing over here. And the exports actually also have been doing quite well in terms of the mobile manufacturing. So all these steps are actually in vision with keeping India for a development growth. In pharma and healthcare, this biopharma Shakti is basically a significant development for the pharma sector. There's additional medical services, caregivers for geriatrics. Basically, that will actually is a very good step for the old age the people. Medical tourism, which is very important. Ayush, basically 3 All India Institutes of Ayush and emergency and trauma care centers in district hospitals. In terms of the tax reforms, no changes, and it was expected. But the good thing is that the tax holiday for cloud services will be there till so basically it's an invitation to foreign players to come up. There has been a significant TCS and TDS reduction. TCS rates have now been cut. STT increased on options and futures to intra-day trading. I think the markets actually took it with a pinch of salt, but the market should appreciate that at the end of the day, this is a small step, or this is basically a step towards eradicating the speculative activities on the F&O segment, which has been repeatedly pointed out by regulators like SEBI and even at the government of India level. So this is basically an incentive, and I don't see it is actually to curtail the price discovery. Customs duty simplification. I think there has been some customs duty simplification has been done. Some customs duty and personal imports have been reduced, and the PIB, I think, has just recently announced comprehensive immigration customs, what you can bring from ever. I think the total value of goods is now to be 75,000, and you can also bring one laptop, which will be duty free. So I think these are all positive steps in terms of allowing the Indian people who are traveling abroad to get things legally into India. Finally, I think major announcement in the budget and sectoral impact, iron and steel, long-term high-speed rail corridors, capital outlay, 20 national highways, then FMCG's launch for integrated development, quality employment, high-value crops. Automobile is no major direct announcement, but duty exemption of capital goods. On power sector, restructuring of Power Finance and Rural Electrification Corporation, all these I think are positive. Then finally, last slide, I should say, I think this is one of the most important phase is that the DISCOMs have reported for the first time a positive PAT of 2,700 crore against a loss of 25,553 crore in year FY 2023-22. You can actually see the losses of the sector. I think the maximum loss is in states like Tamil Nadu, where it is rupees 1.7 trillion. Rajasthan is 91 trillion. Uttar Pradesh is 90,000 crore. Madhya Pradesh is 69,000 crore. So I think Maharashtra. So all the states actually are bleeding in terms of the DISCOMs, and we are crying out for reforms in the DISCOM sectors. Only 2 DISCOMs actually have worked well. One is the Gujarat and the West Bengal, which are actually posting profit. The 16th Finance Commission, I think, has highlighted that the privatization of the DISCOMs could be an opportunity because, as you know, the Air India was privatized. So basically, some sort of a way to make it more efficient, whereby you create an SPV, take out the debt, and do the needful. So I don't know what is be the way forward, but at the end of the day, the only one thing which I'd like to say in the budget or in the future, which if we could do, actually could help us a lot, is basically this improving the financial health of the power discom. So that is one thing. And I would like to end here by saying that I think overall it is a budget which is for everyone. It's a budget which may not have clocked the headlines, but at least the numbers in the budget and are very conservative. And my sense is that over a point of time, I think it will serve the purpose, because whenever the budget basically is understood over a point of time, that has given good reforms. So I'll end here and thank you for this opportunity given to me.
Thank you, Dr. Ghosh. And this was indeed a wonderful session. I'm sure our participants have also found it interesting. And in case they have any question, they may raise their hands in the chat option and we'll take up their questions. So we have received one question from Mr. Dheeraj from Indian Bank. What is India's exposure to outside loan? When fiscal deficit is increasing in domestic market and government expenditure per se, how is India placed in terms of outside borrowing from other countries?
No, I think that's never a feasible solution, because overall interest rates, India's fiscal deficit, if you know, is mostly domestically financed, and any successful country which has a higher fiscal deficit, higher debt like Japan and other things, which is a debt of more than 200%, have actually survived because it is service from inside. So whenever you try to service from outside, with extended depreciation, all these factors are taken into consideration. So I'll never think that that will be a feasible solution in the over term, although there was a talk in between to discuss that, but I think it is best not to go into that direction.
Okay, sir. Thank you. We have one more question from Ashira N. How will banking sector HR reforms align with the budget's strong focus on capacity building and inclusive growth? Specifically, what mechanisms can ensure merit-based promotions, gender equity, and ethical leadership pathways, so that women officers who do not engage in informal favor exchange or unethical practices can still rise to top management?
No, I think this is something which is a continuous process. As I said, as I showed you in one of the I think slides, that the financial services have actually added the most to the bank, to the market capitalization, the last 5 years. Indian banks are now quite strong, and HR reform, of course, is something which the Indian banks have been doing. There has been a lot of the hiring has been also happening from outside from the market. And you know that the banks in India, especially the public sector banks, had to work within an overall overarching framework, whereby it has to support the private sector and also support the public sector and also support abroad. For example, for a bank like SBI, we have a presence in many countries, more than 200 countries in terms of offices. So the objective is significantly large, and in terms of a VIKSHIT Bharat, I think the reforms in the HR is of course a certainty, but you have to go on that HR reforms path in a calibrated fashion. It's not that you will be able to do, because the interest of the people also has to be taken into consideration. And regarding these AI ethical and other things, I think the Indian banks are already at it. I think in our bank also, this is widely used in terms of detection, in terms of, say, identifying the borrowers who may not be, whom the credit may be extended to, in terms of credit scores, in terms of expanding. So I think it's a continuous process, and you have to be patient in terms of the HR refunds, because these are very sensitive issues, and obviously very politically sensitive issues for any public sector units. But I am glad that we have been moving in that direction.
Okay, sir. Now we'll take up Mr. Abhay Kumar's query. Mr. Abhay Kumar, you can unmute yourself and you can ask the question.
Good morning, sir. It's an honor to hear to you, sir, today. I just have one query in mind that government has been increasing their capex continuously and they are implementing it every year. But there is a feeling that the private sector is not responding equally in terms of capital expenditure. So is it changing or is it going to change in coming times?
No, I think government expenditure, capital expenditure set to has moved to 12 trillion. But of course, as you know, you have a budget and 12 trillion is not a small number. So the government has been pushing its capital expenditure significantly on the upside. But I think over a point of time, the private sector capital expenditure is not that it is not packed up. It's picked up. It has picked up. But gone are the days when private sector, I mean, if you compare it with the 2004 to 2008 when private sector investment was going on, I think that was from a low base. And also the facts have now changed. So, and there has been a lot of uncertainties also. So private sector capital expenditure has been working, but hopefully as the demand is coming through, and also we are seeing in a loan book as the demand is coming back after the tax rationalization, I think there is no reason why the private sector investment cannot increase. But the point to note is that it needs to, as I said to you, in that it needs to increase in areas which are going to be sunrise sectors, and that is the reason why it may take a little time. For example, artificial intelligence, for example, renewables, for example, the electronic vehicles, for example, hydrocarbon. And that is the reason why our bank recently launched a center of excellence to ensure that all these newest sectors get adequate fund. So my simple thing is that so therefore, if you have to ask me that why private sector investment is taking a time, I think private sector investment is now going through a structural reorientation towards the sunrise sectors. And the structural reorientation always takes a little bit amount of time. So my sense is that, over a point of time, it is moving from traditional sectors to sectors which basically will dominate the future. And this is also the reason why the FDI flows is also showing a structural orientation in terms of the sunrise sectors, which will take time. And therefore, we have to give them that space.
Thank you, sir.
Thank you, sir. We have now Mr. Priyanshu. Priyanshu, you may unmute yourself and then you may ask your question.
Sir, am I audible?
Yes, Mr. Priyanshu.
Yeah. So, sir, do you believe that the focus given on encouraging entrepreneurship in the budget is adequate, especially in the AI sector, given the trends in the last 3-4 years, what we are encouraging globally, and the response to Startup India scheme and all from the Indian entrepreneurship? So, should we do more at this juncture? That's my question.
No, I think the government has been doing it. There's already a scheme which has launched for the women one, the SHE scheme. And also for the women enterprise, it is doing this Lakpati Didi, which has been a huge success. If you know, this cooperative movement, SSG movement, was earlier restricted to the southern part of India, but it has now actually caught up across India. So my sense is that I think the government has been continuing this initiative, and it will be a continuous process even outside the budget. So encouraging this entrepreneurship has been an focus for this government, and my sense is that it will continue to happen in the current scenario.
Thank you, sir.
Thank you, sir. We'll take one last question from Mr. Suresh Natarajan, Bank of India. He wants to ask you that due to volatility in tariffs, what is the impact on export credit in banking sector and how it affects the forex reserves, and whether IFSC can help in this area?
No, IFSC is already something, I think it's an initiative which has been taken out, but IFSC purpose is basically a little bit different in terms of global integration, is integration with the global markets and other opportunities, investment opportunities in the IFSC center and other things. So its purpose is a little different. And in terms of the export credit, I think the government recently, I think the interesting point which I want to add over here is that earlier when this tariff happened, all of us thought they need a package, they need a relief package, the export credit needs to be enhanced. But the important point to note is that I think the exports actually have turned out to, Indian exporters have turned out to be significantly resilient even after the tariff. Can you believe that India's export growth, the goods export growth of India has been positive in the first 9 months of the current fiscal, and India's overall deficit is actually almost at the same level of last year. I think I never expected that India's current account deficit and other things will be at the same level, even after a 50% tariff, which was there in place from the month of August, and a 25% tariff with so much uncertainty from the month of April. I think Indian exporters have diversified. To your specific question of export credit, yes, it's an enabling phenomenon. But I think Indian exporters have also moved ahead far in terms of diversifying their exports in these uncertain times. So that's why I'll not be surprised that the scheme which was announced by the government in terms of this relief may not be used to that significant extent which was earlier expected.
Thank you, sir, for addressing all the queries of our participant. Now, due to paucity of time, we have to restrict our question and answer session at this point. I now request Professor Dr. K. Gangadharan, Director Academics of Indian Institute of Banking and Finance, to sum up today's webinar and conclude this event with a vote of thanks.
Okay, thank you, Kriya. Good morning to one and all. Most respected Chief Executive Officer of IIBF, Sri Deepak Kumar Lela, our chief guest, and also the renowned economist, Dr. Soumya Gandhi Ghosh, the Group Chief Economist Advisor, SBI, and also the member 16 Finance Commission and member Prime Minister's Economic Advisory Council. My colleagues from IIBF, all designated SMEs for our program, members of IIBF, participants, ladies and gentlemen. At outset, on behalf of the Indian Institute of Banking and Finance, I extend our sincere thanks to Dr. Soumya Gandhi Ghosh, the Group Chief Economic Advisor, State Bank of India, for his insightful and analytical, very enriching address on the Union Budget 26-27 and its implication for the banking sector in the context of VIKSHIT Bharat. For the last 45 minutes, we have been in the fantastic world of budget analysis, and he meticulously done the task with utmost sincerity and honesty by portraying it correctly, how it affects the global economy, how actually the budget is set for the global, and from how the budget is created by the finance minister for specifically for India. So a specific picture has been given in the march towards the VIKSHIT Bharat. Actually, it is seen that the presentation actually provides the budget is not merely a physical exercise, but as a macro financial framework. That is the thing that actually I have taken plans. And it aligns with the growth aspirations with the stability considerations, because he has actually created the global trend, especially in the context of geopolitics and trade wars. Actually, that trend he has created. So the clarity and competence with which he articulates the interlinkage between the fiscal policy, the banking sector, and the entire gamut of the economic segments has been very extremely valuable for all of us, particularly for we are actually practitioners in the field of banking and finance sector. Whatever the changes occur in any of the system may have its consequence and repercussion on the entire banking sector also. So the budget 26-27, as highlighted in today's discussion, places banks as a very center and citadel of India's development journey. The continued thrust on public capital expenditure, the infrastructure development, as well as mentioned, different areas he highlighted, and also the MSME growth, and also the productivity enhancing investment mechanism. All these actually a deeper financial intermediation will be there. So as brought out by sir, this creates actually both opportunities and challenges. So for banks, there is an opportunity. At the same time, it also opens a vista of challenges. We have to be very cautious. So the emphasis on physical consolidation, the structural reforms that carried out the country as a time-bound process, and also the efficiency in public spending, and also it actually reinforces the confidence in the macroeconomic fundamentals. As we know, the budget focus on digital public infrastructure. We have seen that through the database suggested by sir, the financial inclusion, innovative path, etc. Or especially for catering more for the Gram Panchayat and also urban centers. All these are actually the roadmap, a pathway for attaining the VIKSHIT Bharat for 2027. And importantly, the address actually remains that the VIKSHIT Bharat requires banks also has a very important role beyond the traditional lending, especially providing the development finance, the sustainable and actually an improved governance and also the risk assessment capabilities. This also indirectly highlights that by lending, while contributing for the development, we have to take the crucial responsibility of carrying both sides. So in summing up, the budget actually, we can see that by aligning the Union Budget 26-27, the early positions of the banking sector as a key enabler for India's long-term development and vision. So by aligning fiscal priorities with the financial sectors, the reforms, actually the government consider this as the enablers for inclusive growth. Sir has already mentioned that three important attraction of the budget is actually economic development, it is people centricity, and also inclusivity. These are the three cardinal pillars highlighted in the budget. And here we can see that it is actually providing enablers of inclusive growth, partners in innovation, and also ultimately the pillars of economic resilience. So once again, I convey my heartfelt thanks to Dr. Soumya Gandhi Ghosh for enlightening the address and actually providing a bird's eye view of the entire gamut of the budget. Not only for banking sector, he actually focused how it touches the different segments of the economy, and through banks how we can attain the development goal of the VIKSHIT Bharat. So on behalf of IIBF, on behalf of the entire participant assembly, sir, we extend our bottom of heart the sincere thanks for delivering this proper analysis of the budget for us, sir. Sir, in spite of the hectic schedule, you have taken much pain for giving a brief outline of the budget, how it affects the banking sector and also the biggest Bharat pathway of our country. Then we can see that our most respected CEO, Mr. Deepak Kumar Lalla, who extended all support, motivation and encouragement to do the program. Thank you, sir. Thank you very much for all your leadership and also the institute support for making the program a grand success. Then again, our participants, you can see that I thank each and every one of you. They have very patiently listened to the program and also raised questions and made this program very enriching one as part of IIBF. Then again, I take the opportunity to thank our HR for giving the maximum publicity and outreach and also network connection to disseminate the program throughout the country. So on behalf of IIBF, I thank the HR also. Then again, once again, I thank all the participants, all the dignitaries, and all the people associated with the program on behalf of IIBF. Thank you, one and all.
Thank you, everyone. Okay.
Thank you very much.